Okay, folks, so first things first. So another bit of data out today. There's more CPI data out today. It's out in 30 minutes time. So yesterday was like producer inflation data, and today is consumer inflation data. So that could have an impact on both the stock market, interest rates, currencies, TLT, etc., like that. So I'm going to go through that today, but I just wanted to make sure you understood that was out. And as you can see, the S&P keeps grinding higher here at the moment. We're looking at a chart here, but again, not a fan of buying it here. To me, we're at the year-end target. It doesn't mean it's not going to grind higher. I do think over the course of the next 5 to 10 years, you're obviously going to see the S&P 500 much higher than where it is now. Having said all of that, not a fan based on valuation multiples of buying here at all, and not a fan of buying much stock, to be quite honest with you. I just think that there's too much risk out there, and if you given what's happened even in the last 24 to 48 hours in the world, which is quite shocking really, and the market's not budging at all. If you think what's happened with Poland, what's happened in Doha, and what's happened obviously with in the campus yesterday in the US. So, the market doesn't seem to be pricing in any of that risk whatsoever. And that actually worries me, to be quite honest with you. I would much rather see a shakeout in the market and having that risk priced accordingly. But right now, because of Oracle's earnings, for example, the other day, markets are shooting higher. So we look at Oracle. That's the first time in my lifetime, in my investing career, I've ever seen a stock with the valuation of Oracle. So remember, this was $1 trillion stock, or just under it, before its earnings the other day, and it jumped 40% after earnings. I've never seen that before for such a large cap company, a mega cap company. And the earnings for Oracle, by the way, they didn't even meet their expectations for the previous quarter. What it's jumped on is the expectations for what they said about expectations for sales and earnings going forward. So that took everybody by surprise, this big jump in Oracle. And of course, that supported the market a little bit. A lot of the chip makers and everything went up after that earnings report. So everything seems to be jumping up, but it does give you an insight. I've spoken about this before, and I'll say it again. In my opinion, AI is only the beginning of what's coming down the line in technology, and we can't even fathom right now what's actually coming at us in the future. It's probably even impossible to think of. And my view is the rate of change and how things are developed and how fast we move and emerge as a society is just going to get even quicker again, because of AI and quantum computing and everything else that's coming with it. So given that the S&P 500 is made up, pretty much a third of it, more than a third now at this stage, is made up of technology. What companies that we don't even know about that coming down the line in the future are going to become part of the S&P. A lot of crypto-based exchanges and all are all becoming part of it. Robinhood is going to become part of the S&P 500, etc. So like, there's a lot of stuff coming down the line. I just think that this is going to lead to a higher stock market for the next 5 to 10 years. As the technology continues to emerge. But there are significant risks out there that aren't being priced in, and therefore not a fan of buying stocks right here. Not even a fan of doing the ratio put spread here. If anything, and I wanted to take a chance, let's say, and roll the dice, which I'm not prepared to do either, I do something like bear put spreads. But to me, timing this with something that continues to make higher highs, you're kind of asking to lose your money there as well, really. I'd rather much wait to just see a shakeout and then enter the market. So again, if we could get the stock market or the S&P below 6,000 between now and the end of September, which is still a possibility, by the way, then I would be fairly interested in buying in, but not where we are now. I just don't see why you would do it, so that narrative hasn't changed. So for me, S&P, there's nothing really to talk about there. It's not investable for me. And you just have to wait for a correction before you get involved, in my opinion. Looking kind of down to what we've been trading, so I'll talk a little bit about TLT. So you can see what's happened here to bond yields. So we did a good job getting involved in TLT when we did. We probably couldn't have timed it much better, to be honest. So what you're looking at now is a chart of the 10-year bond. You can see how much it's fallen there. It's gone like from 4.4% down to just over 4% in a very short period of time, which is obviously very good for TLT. Now, I decided to exit stage left because of the inflation data that's coming out this week. So yesterday, the producer inflation data was actually better than expected. And then on the flip side, you know, today we've got CPI data. We don't know where that's going to go. For me, this is why I exited TLT. So that's where TLT is gone now, by the way. The reason I've exited TLT is because, to me, if tariffs are, you know, in train now, they should be starting to feed into inflation data at this stage. And I think the risks of CPI data being worse than expected are there. It doesn't necessarily mean, by the way, the yields will actually drop straight away, or sorry, increase straight away, because, you know, the Federal Reserve seem to have indicated that they're going to cut no matter what, right? And even if inflation data is high, they're going to say it's transitory. But I do think it puts a cap on where the cuts can go to. So for me, if you look at the 10-year bond, it's actually priced in 3 rate cuts fully. Okay, so that's 0.75%. With an economy that's going as strong as the US economy is going, with inflation data that still goes to 3%, why would you cut any more than that? Unless the jobs data gets really, really bad. So for me, the risks now are that the 10-year bond, for example, stabilizes here at around 4%, might even creep back up to 4.2%. And if that happens, then TLT would actually come down in value. Now, there's no guarantees. I don't know what's going to be said in 20 minutes' time, or what that date is going to be. It's impossible to know. But what I do know is, in a very short window of time, i.e. 6 weeks, we've taken over 4.5%, close to 5% out of TLT. And I was not prepared, you know, to stay in it and see it back down here again, and we've raised all our gains. So basically, it's a game of patience with this one. For me, there is a potential to get back down here. If we do, I'll be back into it and just keep trading that. So that's a trade I love when the time is right. I've exited it. Maybe I've been very too cautious on this one. We remain to be seen. But I did say the mid-90s is where I was going to exit anyway, in the longer term. I do think longer term, you will see interest rates down further. But in the very short term, i.e. the next 3 months, I think we're probably, the 10 years probably as low as it's going to go. Now, that's assuming CPI data comes in either as normal or worse than expected. If it comes in better than expected, maybe interest rates fall further, but I wasn't prepared to take that chance. For anyone holding TLT now, all I would say to you is, now anyway, the CPI data is going to come out before the market opens. So it is what it is. Hopefully it goes your way. If it jumps again, I will be inclined to take the profit off the table myself. I've already taken my profit off the table. I'm just trying to send a message out there to anyone who's still involved in TLT. You've done very well from it. Most of your break-even points are at 86 or below now with the dividends involved. So no harm taking profit off the table. So I hope that makes sense. This is all data dependent. I'm not sure we get back down to 86, by the way. I think we could maybe split the difference at some stage, and maybe we start looking at it again then. But right now, just I'd rather just let the inflation data come out and see where we're going. Any questions on TLT before we move on? No.
No, thanks, Stephen.
Okay.
Cheers.
I just wanted to talk about Google as well here. Just we've obviously done extremely well out of Alphabet, right? So I just wanted to be really clear on this. You know, like when it got up to here, I was saying I don't think we should sell out. Or sorry, it got up to 220 or so. I was saying I don't think we should sell out. I think we should hold. And then it's exceeded our initial target price, which is 236. So remember, I just want to show you something in Equity Scan. And this is the beauty of this. Maybe some of you aren't using it enough. I just want to show you. when you click on the little history icon here, what it does is it gives you the last 8 to 12 weeks of both analyst target prices and our target prices. So you can see the last timestamp was September the 5th. It's every week. So September the 12th will be the next one, which will be tomorrow, right? But all I'm showing you, I want to show you the trend here in analyst target prices. They've literally gone up since May. They've literally been climbing higher all the way since May. Our target price last week's at 236. We've raised it to over 250 now. Okay. And the reason for that is that we think these analyst target prices will continue to go up. So if you actually look now at the current data on Alphabet here, you can see analyst target price is now at 236. Ours has jumped up to 251. So what we have changed here, guys, so you know, we've changed the PE and the price to sales multiple, and we've increased them. And the reason for that is Alphabet, again, just on this screen here, you can see here, let's say, compared to Microsoft. Microsoft is trading at 27 times earnings, Apple 27 times earnings. We've Alphabet at only 25 times earnings. So it's still trading at a discount. They're not exact direct competitors, but they're pretty close. And you can see here on a price to sales basis, it's still cheaper than these guys here as well. So we were at 23 and 6.5 here in these, and we increased them a bit as well. So just to kind of focus in on Google and just to talk about it a bit more, like, so let's say we get up to 250 on this, right? I think it'll do it by Christmas. You know, people are going to ask me then, should I sell? And for me, the answer to that is not straightforward. For people who are just sticking to the rules, it's hit my target price, I'm out, absolutely sell. There's nothing wrong with doing that. But if you're a longer term person, I think you're going to see Alphabet in 5 to 10 years at a totally different valuation again. So what I'm saying is there's nothing wrong to holding on to this, but you just got to be prepared for short-term pullbacks. You know, I think the growth potential for someone like Alphabet is exponential, given the projects that they're involved in that we don't even know about yet. So sorry, guys, there's just somebody there with feedback. Can I ask you to mute your mics? And if you want to ask a question, just jump in. Be great. Thanks. So yeah, Alphabet just for me, even if it hits 250, if you said, Steve, I'd love to hold on to it, I would say, yeah, go ahead. It's just one of those stocks. I wouldn't say that for every stock that I own, by the way. It's just one of those stocks in Alphabet. So let me contrast that with Entain, which we owned and sold out of. When Entain got up here, now we got our time and bang on here, you know, it was pretty good. Look what's happened since. You know, I felt the valuation was full there and just didn't feel the need to stay involved in the stock. Now that it's pulled back a bit, it's getting more and more interesting. Probably would look to buy more if it came back to the 200-day moving average, probably get involved again. But I'm just trying to show you the difference and highlight the difference to you there. It's just a case of not really looking at the stock that Google and Alphabet is and where they're involved and what I'm talking about. Don't forget their involvement in quantum computing down the line. So even if it hits its target price, if you said to me, I'm holding this for the next 5 to 10 years, I think you're going to be very happy over that period of time. Okay. So that's just Alphabet. I wanted to cover that off. So well done to those of you who got on board. Other stocks there that we'd been following, I kind of started to retrace. So remember, we were getting involved in this, then we had the earnings out and it kind of just jumped on us. We never got a chance. It kind of retraced back to here. I would just love to see it get down to this 155, 160 level, and then I think that could be tradable. I think that potentially could go between 150, 160 and 200 for the foreseeable future. Okay. Forget about Alaska Airlines for now. It's just gone up too much. Kingspan, again, we're at this down, like this downtrend is still intact. You can see what I'm talking about here. It's really, really clear. You can't get any clearer than that. And that's why I'm just avoiding it. But as I said, I like the valuation of the stock. Having said all of that, what's the damage going to be? Tariffs into the US, etc., like that. When are we going to see some sort of pickup in these states, for example, that I'm talking about, where rebuilds have to be done. So, you know, that's going to be a timing issue. So again, I think you're better off just holding the wish than buying anything, to be quite honest with you, because it's just so difficult to predict which companies and which sectors he's gone after next, and that really boils down to that, you know. So the other thing we spoke about recently was natural gas. So natural gas, as you can see, we were in this established downtrend. We were waiting on it to get to 250, got to 266, didn't get to 250 on us, and it's gone on a bit of a rally. So why is it rallied? Well, the supply data has been better than expected. So in other words, storage has started to shrink again, which is good for obviously natural gas prices. And then there's been weather forecasts that are shifting in the US, which suggests that there actually would be a bigger demand for natural gas. So those two combined have caused this rally in natural gas. But I would continue to wait and be patient on that one. As I keep saying to people, that's one thing, that natural gas, it's a really volatile commodity. It can be up 20% one week and down 20% the next. And you really want to be as close to that 250 or even below it as possible. To give you that degree of comfort going forward, that look, I can averaging in from where it is now, I just think it's a bridge too far for something that's as volatile. And just to show you where this can go, you know, there it is down there at 150 and 160 before. So like, that's 50% off, guys. That's what I'm talking about. Very hard to manage your way out of that if that did happen. I'm not saying it will go down there. I don't think it will. But it's just just trying to explain why I'm being so patient with this one. Okay. So really, just looking at currencies just right at the end, the dollar's kind of just marking time, going sideways here against the euro. My own view is I think that's probably going to weaken out to 120 at some stage. I wouldn't be a betting man on it though. And likewise, after that's all said and done, I actually think we're going to see a stronger US dollar. But I suppose, and then looking at the British pound and versus the US dollar, it's something similar. You can see the trend is the same. The challenge I have with all of this, guys, is just look at what's going on in the world, which we need to consider what happened in Poland and what's that going to lead to. So the markets are discounting everything. They don't seem to think it's going to have any impact whatsoever. But there's certainly a bigger risk. If you think about in Poland, the drones going into Poland, war games happening between Belarus and Russia this month, you know, that's something similar to what happened in the Ukraine as well, by the way, before they invaded the Ukraine. So it's something that's there, and it shouldn't be discounted or ignored. Likewise, you know, what Israel into Doha as well, all this can't be ignored. It's just, it's out there, and I think that has potential knock-on impacts to US dollars, to everything, to the stock market, and that's why I'm thinking sitting on cash right now, it ain't a bad thing. And I know it's hard to be patient and just to wait, but it's not a bad thing right now in my view. Just given that the risks that are out there, unless we've seen some sort of a shakeout and some sort of a pricing in of risk, which we're not seeing whatsoever. And I just don't like that. Okay. So I've spoken enough there, folks. I'm going to open it up to questions. Is there anything you want me to speak about? Any stocks you want me to have a look at?
Yeah, hi Stephen. If you would, two questions, if you don't mind.
Yeah.
You said you see the US dollar strengthening in the near future. What do you think could be driving that strength?
So no, sorry, just to be clear, I would imagine the US dollar will weaken from here.
Right.
120 in the very short term, but in the medium to longer term, I think it will strengthen again. So, and the reason for that, Richard, is I think the Fed's amount of rate cuts are going to surprise everybody. They're probably going to be lower than expected, unless the US economy goes into a recession. Then I think the US dollar will remain weak. So assuming I'm correct and the US economy does not go into a recession, I actually think then at that stage, assuming the political risk has reduced, actually US dollars become very desirable, and I think
Right.
that actually will cause it to be strengthened, in my opinion.
Yeah.
So I just don't see the Fed cutting rates. I think the market might get even shocked. They might even cut 3 times. So for
Very
me,
good. Thanks.
so for me, that would equal a stronger dollar. And we need to understand what caused this. Why did the dollar weaken? If we go back to here, so this is kind of your start of your tariffs, right? There was a massive dumping of US assets in this period of time,
Yeah.
which caused the dollar to weaken. Obviously, with the uncertainty, everything else that was going on. So assuming that is going to be unwound at some stage, I think we could see it back down at 110, 112. But in the very short term, the fact that the Fed are likely to cut next week, because they pretty much told everybody, I would imagine that, that there is a risk of this actually weakening in the short term to 120. But I wouldn't be a betting man on it, Richard.
Yeah, sure. My second question was just related to natural gas. I'm still holding Coterra. I would just love to get your opinion on it.
I would continue to hold Qatar. It's a great company. Earnings have been very, very good. If you look at it here,
dividends are pretty good too.
Dividends are good. Yeah, I will continue to hold it. Target prices come down a tad. Our target price is now back up here at 30. So in hindsight, probably should have sold out back here when it got to 30.
Yeah.
But I would hold it. I think you're going to see it up at 30. Don't forget, you know, as Russia escalates, I think you're going to see the US be dragged in my opinion. This is the way this could play out. Become closer allies with Europe and everything. And what's that got to do with natural gas? I think the exports, I think Russia get totally cut off from any type of production or delivery of natural gas. And the US become the net exporter and benefit from that. So for me, I think there's a potential in that alone. So I think Qatar will be fine here. If natural gas starts to rise as we come into the winter, you're going to see this back up at 28, 29, you know?
Yeah. Very good. Thanks, Stephen. That's all from me. So cheers.
No problem, Richard. Anybody else? No. Okay. So just in summary, guys, I know this is a quick one this week because we don't have a lot to talk about. S&P 500, not doing anything. No trades there. TLT, if it were me, I would sell out and take the profit off the table. My rationale for that is market's already priced in 3 rate cuts. If inflation data starts to come in hotter than expected, you might see the bond yield start to creep back up again, which will mean TLT come down. Again, if you're thinking longer term, I do think you'll be okay in the longer term, and you're getting paid a great dividend with it anyway. But for somebody who doesn't want to see their 4 or 5% gain that they've got in a month dissipate, take the profit off the table, nothing wrong with that. And then when it comes to Alphabet and Google, nothing wrong with holding that for the long term, as in never sell it. But if it does get to 250, that is short-term target. Probably take the profit off the table there if you are concerned about giving away any profits on Alphabet or Google. The other thing is natural gas, not ready to trade it just yet. If it did drop to 250, certainly we would have a look at it then. So right now, there's not an awful lot on, guys. I think you're better off being patient, and you've done well out of TLT, depending anyway, but and Google, depending on how much you've actually put into TLT. So I think you're better off sitting tight here. Okay. All right, folks, we'll leave it there. Have a great day, and we'll chat to you again soon.
Thanks, Stephen. See you, lads.
Thank you.
Thanks, guys.